Gold has long been regarded as a protector of wealth during economic crises because it behaves differently from most financial assets when systems come under stress. Throughout history, periods of economic turmoil have repeatedly shown how fragile paper-based wealth can be. Stock markets may collapse, banks may restrict withdrawals, currencies may lose value, and governments may struggle to maintain confidence. In such moments, gold stands apart because it does not rely on the performance of corporations, the stability of financial institutions, or the promises of governments. Its value is rooted in scarcity, durability, and universal trust rather than economic growth or political stability. When an economic crisis begins, fear usually spreads faster than facts. Investors rush to sell risky assets such as stocks, corporate bonds, and speculative investments. Prices fall sharply as confidence evaporates. Gold, however, often moves in the opposite direction because it is viewed as a refuge rather than a risk. Investors shift their capital into gold not to chase profits, but to preserve purchasing power. This defensive demand has been observed during major crises such as the Great Depression, the 1970s stagflation period, the 2008 global financial crisis, and the economic uncertainty that followed the COVID-19 pandemic. One key reason gold protects wealth during crises is that it has no earnings dependency. Stocks rely on company profits, which decline when economies slow. Bonds depend on borrowers' ability to repay, which becomes uncertain when defaults rise. Even government bonds can lose credibility if public debt becomes excessive. Gold does not generate income, but it also does not depend on income. Its value does not disappear when businesses fail or when governments struggle to balance budgets. This independence allows gold to remain stable when other assets are collapsing. Another crucial factor is gold's resistance to financial system failure. During severe crises, banking systems may freeze. Credit can dry up, withdrawals may be limited, and payment networks can face disruptions. In such scenarios, wealth held inside the financial system becomes vulnerable. Gold, especially physical gold, exists outside this system. It is not a digital entry, a bank promise, or a liability on someone else's balance sheet. This characteristic gives gold a unique role as a form of wealth that remains accessible even when financial infrastructure is under pressure. Economic crises are often accompanied by aggressive policy responses from governments and central banks. To stabilize economies, authorities may cut interest rates, inject liquidity, and print large amounts of money. While these actions can provide short-term relief, they often carry long-term consequences such as inflation and currency depreciation. Gold historically performs well in such environments because it cannot be created at will. Its supply grows slowly and predictably, making it resistant to the dilution that affects fiat currencies during crisis-driven money creation. Confidence is another central element during economic breakdowns. Modern financial systems rely heavily on trust in banks, trust in governments, and trust in currencies. When that trust erodes, people seek something tangible and time-tested. Gold has served as a store of value for thousands of years, across empires, wars, and collapses. This long history reinforces confidence in gold when newer systems feel uncertain or unstable. Investors often describe gold not as an investment during crises, but as insurance. Gold also provides psychological stability during economic stress. While numbers on screens can fluctuate wildly, gold's physical presence gives a sense of permanence. This psychological factor should not be underestimated. During crises, emotional decision-making increases, and assets perceived as real or solid gain appeal. Gold's tangible nature helps anchor value perceptions when abstract financial products lose credibility. Global demand further strengthens gold's role during crises. Economic turmoil is rarely confined to a single country. As uncertainty spreads internationally, investors across different regions move toward gold simultaneously. This broad demand base supports prices even when local economies weaken. Unlike assets tied to specific markets or industries, gold benefits from worldwide recognition and acceptance, making it resilient during synchronized global downturns. Gold's performance during crises is not about short-term speculation, but long-term preservation. While prices can fluctuate in the short run, gold's primary function is to protect purchasing power over extended periods of instability. Investors who hold gold through crises often find that it helps offset losses in other parts of their portfolios. This balancing effect reduces overall financial damage and helps preserve wealth until conditions stabilize. In addition, gold carries no default risk. When companies fail, shareholders can lose everything. When governments default or restructure debt, bondholders suffer losses. Gold cannot default. It does not promise future payments that might be broken. Its value exists independently of contracts, making it uniquely reliable during systemic stress. Another important aspect is liquidity. Even during crises, gold markets tend to remain active. Gold can be sold, exchanged, or pledged as collateral in many parts of the world. This liquidity provides flexibility to investors who may need access to funds when other markets are frozen or functioning poorly. The ability to convert gold into cash across borders adds to its crisis-resistant nature. Economic crises also reshape investor priorities. Growth becomes less important than survival. Wealth preservation replaces wealth expansion. Gold aligns perfectly with this shift in mindset. It does not promise rapid gains, but it offers durability. Over time, this durability has proven more valuable than high returns during periods of instability. Ultimately, gold protects wealth during economic crises because it represents continuity in a world of disruption. Financial systems can change, policies can fail, and institutions can collapse, but gold retains its role as a trusted store of value. Its independence, scarcity, global acceptance, and historical reliability combine to make it one of the most effective tools for preserving wealth when economic foundations are shaken. Gold holds value when currencies lose power because it exists outside the weaknesses that affect paper money. Fiat currencies are created and managed by governments and central banks, and their value depends largely on public confidence, economic discipline, and monetary policy decisions. Over time, history shows that most fiat currencies steadily lose purchasing power due to inflation, debt expansion, and excessive money creation. Gold, by contrast, is not tied to any single authority and cannot be printed or devalued through policy decisions, allowing it to preserve value across generations. Inflation is the primary mechanism through which currencies lose power. As governments increase spending beyond their revenues, they often rely on borrowing or money creation to fill the gap. Central banks inject liquidity into the economy, increasing the supply of currency in circulation. When more money chases the same amount of goods and services, prices rise. Each unit of currency buys less than before. This erosion of purchasing power may appear gradual, but over decades it becomes severe. Gold resists this process because its supply grows slowly and cannot be expanded to match political or economic demands. Historically, fiat currencies have been temporary. Empires have risen and fallen, each issuing their own money, yet gold has remained valuable across all of them. From ancient civilizations to modern economies, currencies have been reset, devalued, or replaced, often wiping out savings in the process. Gold has survived these transitions because it is not dependent on trust in a single system. When currencies fail, gold does not need reform, restructuring, or bailout. It simply continues to hold value. One of the key reasons gold maintains purchasing power is its scarcity. Gold is rare, difficult to mine, and costly to extract. These natural limitations prevent sudden increases in supply. Fiat money has no such constraint. Governments can create currency digitally or physically with minimal cost. This imbalance between unlimited supply and finite supply is why currencies trend downward in value, while gold remains stable over the long term. Currency debasement has been used repeatedly throughout history as a solution to financial pressure. Governments facing debt crises often reduce the real value of their obligations by inflating the currency. While this strategy may ease short-term burdens, it transfers the cost to savers and wage earners. Gold acts as a shield against this silent loss. As currencies weaken, gold prices tend to rise in nominal terms, reflecting the declining value of money rather than gold becoming inherently more valuable. Gold also holds value during currency crises because it is globally priced and recognized. When a local currency collapses, citizens often rush to convert savings into more stable assets. Gold serves this role effectively because it can be valued independently of domestic monetary systems. Whether in developed or emerging economies, gold offers a universal reference point when local currencies lose credibility. Another reason gold protects wealth during currency weakness is its neutrality. Currencies are political tools. Their value is influenced by elections, policy shifts, trade decisions, and geopolitical conflicts. Gold is politically neutral. It does not favor one country over another and is not directly affected by sanctions or policy failures. This neutrality makes gold particularly attractive when political instability undermines confidence in national currencies. Interest rates also play a role in currency strength. When central banks keep rates low for extended periods, currencies often weaken because returns on savings decline. Investors seek alternatives that preserve value. Gold becomes more appealing in such environments because it does not rely on interest income. Its value is not diminished by low yields, making it competitive when real interest rates fall below inflation. Gold's role as a currency alternative becomes even more evident during hyperinflationary episodes. In such cases, money can lose value at an extreme pace, sometimes within days or hours. Historical examples show that gold often becomes a parallel currency in these situations. People use gold or gold-linked assets to trade, save, and measure value when official money becomes unreliable. This practical use reinforces gold's reputation as a monetary anchor. Psychology also contributes to gold's ability to hold value. People understand gold intuitively. Its physical presence, weight, and appearance convey permanence. This perception strengthens trust during times when paper money feels abstract and unstable. When confidence in institutions declines, trust shifts toward assets that feel real and enduring. Gold benefits from this deep-rooted psychological association with value. Another important factor is gold's independence from debt. Modern currencies are closely tied to debt-based systems. Money is often created through lending, meaning it represents an obligation rather than a stored value. Gold carries no such obligation. It does not represent someone else's liability. This independence allows gold to maintain value even when debt levels become unsustainable and currencies weaken as a result. Gold also benefits from long-term consistency. While short-term price movements can be volatile, gold's purchasing power over decades has remained relatively stable. What an ounce of gold could buy generations ago often remains comparable today. This consistency contrasts sharply with currencies, which steadily lose the ability to purchase the same goods over time. In international trade and reserves, gold continues to play a stabilizing role. Central banks hold gold as part of their reserves precisely because it is not tied to another country's currency. When exchange rates fluctuate or confidence in reserve currencies declines, gold provides balance. This institutional demand further supports gold's value during periods of currency weakness. Gold's ability to hold value is also reinforced by its cultural and historical significance. Across societies, gold has symbolized wealth, security, and permanence. This shared understanding transcends borders and economic systems. Even as financial instruments evolve, this cultural foundation ensures ongoing demand for gold when currencies face uncertainty. Ultimately, gold holds value when currencies lose power because it operates on different principles. It is scarce where currencies are abundant, stable where currencies are fragile, independent where currencies are political, and tangible where currencies are abstract. These qualities allow gold to preserve purchasing power through inflation, monetary mismanagement, and systemic change. When currencies weaken, gold does not need rescue or reform. It simply reflects reality. As money loses value, gold exposes that loss by rising in price. In doing so, it protects wealth not by promising growth, but by maintaining truth in value. That is why, across centuries of monetary experiments, gold has remained a reliable store of wealth when currencies inevitably lose power. Gold is independent of governments and banks, which is one of the strongest reasons it has remained a trusted store of value throughout history. Unlike fiat money, which is issued, regulated, and controlled by central authorities, gold exists outside political and financial systems. Its value does not rely on laws, promises, or policy decisions. This independence gives gold a unique strength, especially during times when trust in institutions weakens. Modern financial systems are built on trust in governments and banks. People trust that central banks will manage money responsibly, that governments will honor debts, and that banks will safeguard deposits. However, history repeatedly shows that this trust can be broken. Governments change policies, banks fail, and financial rules are rewritten during crises. When these failures occur, assets tied to the system can lose value rapidly. Gold, by contrast, does not depend on institutional credibility, allowing it to remain valuable even when systems collapse. One of the most important aspects of gold's independence is the absence of counterparty risk. Counterparty risk exists when the value of an asset depends on another party fulfilling an obligation. Bank deposits rely on banks remaining solvent. Bonds rely on issuers repaying debt. Even digital assets often depend on platforms, networks, or custodians. Gold carries no such dependency. Owning physical gold means no one else needs to act for it to retain value. It does not default, freeze, or require enforcement. Gold's independence also protects it from policy manipulation. Governments frequently adjust monetary and fiscal policies to manage economic conditions. While these tools can stabilize economies in the short term, they can also distort currency values, inflate asset bubbles, and erode savings. Gold is unaffected by interest rate changes, quantitative easing, or deficit spending decisions. This insulation makes gold a reliable hedge when policy outcomes become unpredictable or harmful. Banking systems, despite regulations, remain vulnerable to crises. Bank failures, liquidity shortages, and systemic risk events can restrict access to funds. In such moments, depositors may face withdrawal limits, delays, or losses. Gold held outside the banking system remains accessible regardless of banking conditions. This physical separation from financial institutions provides security that digital balances cannot always guarantee. Gold's independence is particularly valuable during political instability. Changes in leadership, conflicts, or policy shifts can rapidly alter economic direction. Currencies often respond negatively to uncertainty, while capital controls or emergency measures may be imposed. Gold is not subject to political loyalty or national borders. Its value is recognized globally, allowing it to function as portable wealth even when domestic systems are under stress. Central banks themselves recognize gold's independence, which is why they continue to hold it as a reserve asset. Despite advances in financial instruments, gold remains part of official reserves because it is no one else's liability. Reserve currencies depend on the issuing country's economic health and political stability. Gold does not. This distinction becomes critical when confidence in major currencies weakens. Another key advantage of gold's independence is its resistance to confiscation through inflation. Governments can indirectly reduce the value of savings by expanding the money supply, but they cannot inflate gold itself. While taxes or regulations may affect ownership, gold's intrinsic scarcity prevents value dilution through monetary expansion. This makes gold a powerful tool for preserving wealth against systemic erosion. Gold's independence also extends to technological risk. Modern finance relies heavily on digital systems, networks, and infrastructure. Cyber attacks, technical failures, or power disruptions can temporarily paralyze access to digital assets. Physical gold remains unaffected by such risks. Its value does not depend on electricity, internet connectivity, or software integrity, reinforcing its role as a resilient asset. In times of extreme crisis, governments may impose extraordinary measures such as capital controls, account freezes, or emergency regulations. These actions are designed to stabilize systems, but often limit individual financial freedom. Gold held independently provides a degree of autonomy in such situations. It allows individuals to maintain value without relying entirely on regulated channels. Gold's independence also contributes to its long-term credibility. Financial systems evolve, but gold's role has remained consistent. It has been used as money, reserves, jewelry, and wealth storage across civilizations. This continuity builds confidence that gold will continue to be valued regardless of future system changes. Few assets can claim such a long and uninterrupted history of trust. Unlike currencies, gold does not require confidence to exist. Currencies function because people believe others will accept them. Gold's value is inherent in its properties and scarcity. Even if trust in institutions collapses, gold retains usefulness and desirability. This makes it a foundational asset rather than a derivative one. Gold's independence also limits exposure to regulatory risk. Financial assets are subject to changing rules, reporting requirements, and compliance burdens. While gold ownership can be regulated, its physical nature makes it less vulnerable to sudden structural changes. This stability appeals to those seeking long-term security rather than short-term gains. Another important element is gold's independence from debt cycles. Modern economies operate on expanding debt. As debt grows, currencies face pressure, and financial systems become more fragile. Gold exists outside this cycle. It does not represent borrowed value or future repayment. This separation allows gold to perform well when debt levels become unsustainable and confidence erodes. Gold's independence also supports personal sovereignty. Holding gold gives individuals direct ownership of value without intermediaries. This autonomy is especially important in uncertain environments where reliance on third parties increases risk. Gold empowers individuals to preserve wealth on their own terms. Culturally, gold's independence reinforces its symbolism as real money. Across societies, gold represents permanence and reliability precisely because it stands apart from authority. Kings, governments, and institutions change, but gold remains. This perception strengthens its appeal during times of institutional doubt. In conclusion, gold is independent of governments and banks in ways no fiat currency or financial instrument can fully replicate. It carries no counterparty risk, resists policy manipulation, avoids systemic dependence, and maintains value beyond political and financial boundaries. This independence is not theoretical. It has been proven repeatedly during crises, collapses, and transitions. When trust in systems weakens, gold does not need reassurance. It does not depend on laws being upheld or promises being honored. Its value exists on its own. That is why, in an uncertain world shaped by debt, politics, and fragile institutions, gold remains a cornerstone of financial security. Its independence is not just a feature. It is the foundation of its enduring role as a safe haven. Gold is universally trusted worldwide, a status no other asset has been able to maintain across civilizations, borders, cultures, and economic systems. From ancient empires to modern nations, gold has consistently been recognized as a reliable store of value. This universal trust is not based on temporary belief or political agreement, but on thousands of years of shared human experience. Regardless of language, religion, or geography, gold has been valued as money, wealth, and security. One of the primary reasons gold is universally trusted is its consistency across time. Civilizations rise and fall, currencies appear and disappear, but gold remains. Ancient Egyptians used gold as a symbol of wealth and divinity. Roman empires minted gold coins, and Asian dynasties stored gold as treasury reserves. Even today, gold plays a central role in global finance. This uninterrupted acceptance builds confidence that gold will continue to be valued in the future. Gold's trust transcends national borders. A currency is typically only valid within the issuing country or among trade partners who accept it. Gold, however, is accepted everywhere. Whether in developed economies or emerging markets, gold can be exchanged, sold, or valued without requiring conversion agreements. This borderless acceptance makes gold uniquely powerful during international crises or global uncertainty. Cultural recognition further strengthens gold's universal trust. In many societies, gold is deeply embedded in traditions, ceremonies, and social values. It is used in weddings, religious rituals, and inheritance across continents. These cultural roles reinforce gold's importance beyond economics. People trust gold not only because markets value it, but because societies have always respected it as a symbol of stability and prosperity. Gold's physical nature also contributes to global trust. Unlike digital assets or paper money, gold can be seen, touched, weighed, and tested. This tangibility provides reassurance. People do not need complex systems or technology to verify its existence. A gold bar or coin is immediately recognizable, which makes it trustworthy even in environments with limited infrastructure or unstable institutions. Another factor behind gold's universal trust is its standardized quality. Gold purity and weight are globally understood and regulated through widely accepted measures. A gram of pure gold holds the same value characteristics regardless of where it is produced. This standardization allows gold to function as a universal financial language, eliminating confusion and uncertainty in valuation. Gold's role in central bank reserves further reinforces its global credibility. Central banks across the world, including those of major economies, continue to hold large amounts of gold. They do so because gold is not tied to any single nation's political agenda. When countries diversify reserves, gold serves as neutral ground. This official endorsement strengthens public and institutional trust worldwide. Trust in gold also grows during times of geopolitical tension. When conflict arises between nations, currencies can become tools of political influence or sanctions. Gold stands outside these power struggles. It does not belong to any one country and cannot be printed or controlled by political rivals. This neutrality makes gold especially trusted when international relations become strained. Gold's universal trust is also linked to its historical role as money. Long before modern currencies, gold functioned as a medium of exchange. Its properties made it ideal for trade: durable, divisible, scarce, and portable. Even though gold is no longer used as everyday currency, the memory of its monetary role remains embedded in collective consciousness, reinforcing trust. In developing economies, gold often plays a critical role in personal savings. In regions where banking systems are weak or inflation is high, people rely on gold to preserve wealth. This reliance strengthens gold's reputation as dependable money. Families pass gold down generations, trusting it to retain value when other systems fail. Gold's global market structure also supports trust. It is traded on major exchanges worldwide, with transparent pricing influenced by global supply and demand. This liquidity ensures that gold can be converted into cash almost anywhere. Knowing that gold can be sold easily reinforces confidence in holding it as an asset. Another important aspect of gold's universal trust is its independence from ideology. Financial systems often reflect political or economic philosophies. Gold does not. Capitalist, socialist, and mixed economies alike value gold. This ideological neutrality allows gold to be trusted regardless of the governing system in place. Gold's resistance to manipulation further builds trust. While markets can fluctuate, gold supply grows slowly and predictably. It cannot be created at will by governments or institutions. This natural scarcity prevents sudden devaluation, reassuring holders that their wealth cannot be diluted arbitrarily. During humanitarian crises, gold often becomes a lifeline. Refugees and displaced individuals frequently carry gold jewelry or coins as portable wealth. Across borders, gold can be exchanged for necessities. This real-world functionality reinforces gold's reputation as universally trusted money in the most extreme conditions. The trust in gold is also psychological. People associate gold with permanence and security. Its luster does not fade. It does not rust or decay. This physical permanence mirrors its financial reliability, strengthening emotional trust alongside rational confidence. Gold's acceptance across generations further reinforces its credibility. Parents trust gold enough to pass it to children as inheritance. This long-term trust is rare in financial assets, many of which are designed for short-term gains. Gold's generational appeal confirms its role as enduring wealth. In times of currency collapse, gold often becomes the reference point for value. When paper money loses meaning, people turn to gold to price goods and services. This recurring pattern across history proves that trust in gold reemerges whenever monetary systems fail. Even in modern digital economies, gold retains trust. While financial innovation introduces new assets, gold remains relevant. Investors use it as insurance. Institutions hold it as reserves, and individuals buy it as protection. This adaptability shows that trust in gold evolves without disappearing. Gold's universal trust is not accidental. It is earned through centuries of reliability, cultural significance, physical integrity, and financial neutrality. No other asset has maintained such broad acceptance for so long. In conclusion, gold is universally trusted worldwide because it transcends borders, systems, and time. It is recognized across cultures, accepted in all economies, and relied upon in both prosperity and crisis. This trust is deeply rooted in human history and reinforced by modern financial reality. Gold does not need endorsement to be valuable. The world already believes in it. That belief is why gold remains one of the most trusted assets humanity has ever known. Gold holds a unique position in human history because it preserves value when paper currencies fail to do so. From ancient civilizations to modern financial systems, gold has repeatedly proven that it can maintain purchasing power even as currencies rise and fall. Fiat money, which is backed by government authority rather than a physical asset, is inherently vulnerable to inflation, debt expansion, and loss of public trust. Gold, by contrast, exists independently of political systems and monetary policies, making it a long-term store of value when currencies lose power. Inflation is one of the primary reasons currencies weaken over time. When governments increase the money supply to fund spending, stimulate growth, or manage debt, each unit of currency loses value. Prices rise, and consumers can buy less with the same amount of money. History shows that inflation is not an occasional event, but a recurring feature of fiat-based systems. Gold responds differently to inflation because it cannot be printed or created at will. Its limited supply means that as paper money becomes more abundant, gold often becomes more valuable in relative terms. Throughout history, major inflationary periods have demonstrated gold's ability to protect purchasing power. In the 1970s, for example, the United States experienced high inflation due to oil shocks, excessive spending, and loose monetary policy. During this time, the U.S. dollar lost significant value, while gold prices rose dramatically. Investors who held gold were able to preserve their wealth, while those relying solely on cash saw their savings eroded. This pattern has repeated in many countries across different eras. Currency devaluation is another major threat to wealth. Governments may intentionally weaken their currency to boost exports or reduce the real value of national debt. While this strategy can provide short-term economic relief, it reduces the currency's purchasing power and damages public confidence. Gold acts as a hedge against devaluation because it is priced globally and does not depend on any single nation's economy. When a currency weakens, gold prices in that currency often rise, offsetting losses for holders. Hyperinflation offers the most extreme example of currency collapse. Countries such as Zimbabwe, Venezuela, and Weimar Germany experienced periods when money became nearly worthless. In these cases, everyday transactions required enormous amounts of cash. Savings were wiped out, and trust in the monetary system disappeared. Gold, however, retained value even during these crises. Those who held gold or gold-backed assets were better able to survive financially, often using gold to trade for goods or convert into more stable currencies. Central bank policies also play a crucial role in weakening currencies. Interest rates, quantitative easing, and debt monetization can all undermine long-term currency value. When central banks keep interest rates artificially low, savers earn less on deposits, discouraging saving and encouraging borrowing. Over time, this reduces confidence in the currency. Gold does not rely on interest rates for its value. Instead, it benefits when real interest rates are low or negative, as the opportunity cost of holding gold decreases. Gold's role as a store of value is reinforced by its physical nature. Unlike digital money or bank deposits, gold is a tangible asset that cannot be erased, frozen, or defaulted on. This physicality becomes especially important during times of financial stress, banking crises, or capital controls. When people fear losing access to their money, demand for gold often increases. This demand supports its value even as currencies weaken. Another reason gold holds value is its universal acceptance. Gold is recognized and valued across cultures, borders, and economic systems. While currencies are limited to specific countries or regions, gold is global. This universality allows gold to function as an alternative form of money when confidence in national currencies declines. In times of geopolitical tension or economic fragmentation, gold's neutrality becomes especially valuable. Long-term data further supports gold's ability to preserve purchasing power. Over decades and even centuries, gold has maintained a relatively stable relationship with essential goods such as food, housing, and labor. While short-term price fluctuations occur, gold's long-term trend reflects its role as a wealth preserver rather than a speculative asset. A unit of gold that bought a quality garment centuries ago can still buy a comparable item today, while paper currencies have lost most of their original value. Modern investors continue to rely on gold for protection against currency risk. As global debt levels rise and governments face increasing fiscal pressure, concerns about future inflation and devaluation grow. Gold provides a form of insurance against these risks. It does not generate income like stocks or bonds, but its purpose is preservation rather than growth. This makes it especially attractive during uncertain monetary environments. Digital currencies and financial innovation have not replaced gold's role. Instead, they have highlighted its stability. While new forms of money promise efficiency and speed, they remain dependent on technology, regulation, and trust in issuers. Gold requires none of these. Its value is intrinsic, based on scarcity, durability, and human trust developed over thousands of years. When experimental systems fail or face instability, gold often regains attention. Psychology also plays a role in gold's performance during currency weakness. When people lose confidence in money, they seek assets that feel safe and permanent. Gold benefits from this collective behavior. Fear of inflation, debt, or systemic failure drives demand, reinforcing gold's price and perceived reliability. This psychological dimension has been consistent throughout history and remains relevant today. In developing economies, gold often serves as a practical hedge against unstable currencies. In countries with weak financial systems, people commonly save in gold jewelry, coins, or bars. These forms of gold act as portable wealth that can be sold or exchanged when needed. This practice highlights gold's role not just as an investment, but as a survival asset in uncertain monetary environments. Gold also protects wealth across generations. Currencies change, governments fall, and economic systems evolve, but gold endures. Families and institutions have used gold to transfer value over long periods, unaffected by political or monetary shifts. This intergenerational reliability is something no fiat currency has ever achieved. In conclusion, Gold holds value when currencies lose power because it is scarce, independent, universally trusted, and historically proven. Inflation, devaluation, and monetary mismanagement consistently erode paper money. But gold resists these forces. Its physical nature, global acceptance, and psychological appeal make it a reliable store of wealth during currency weakness. While no asset is perfect, gold's track record across centuries confirms why it remains a cornerstone of financial protection in an uncertain monetary world.